What's up, everyone? Rose Brown, the accountant therapist here, and today I'm breaking down the different ways that an LLC can be taxed. Now, recall an LLC is organized on the state level, so it's not incorporated, it's just organized on the state level, which means for the IRS, they consider it a disregarded entity, meaning it doesn't just sit by itself, it depends on you personally in order for it to be filed, right? So I'm going to show you an illustration of the different ways you can be taxed as an LLC and then the different impact that comes with that. Okay, so let's jump right into it. An LLC can be taxed one of three ways, right? You can remain the default, which is the disregarded entity, or you can choose to elect to file taxes as an S corporation or a C corporation. Now, an election is you completing a document asking the government to treat you as either one of these, right? So if you decided to just remain your disregarded entity status, you would have to file taxes on a Schedule C, which needs to be reported as part of your personal income tax return. What that also means is you can't file your personal then your business. They have to be done together. So if you've already filed your personal income tax return, that means you would have to amend so that you can reflect the business activities on that Schedule C. Right? If you chose to go the S corporation route, you're looking at filing a Form 1120S. Now, that Form 1120S is a completely separate tax return. However, because taxes are not assessed at the business level, the net activities will flow through to you or whomever else may own a portion of that S corporation, and you both or just you would be responsible for those income taxes. Right. And then lastly, you have your C corporation, which would be reflected on a Form 1120. Again, that's a completely separate tax return. And in this case, independent of you personally. So you will never see the net activities from the C corporation reflected on your personal tax return. Which leads me to the fact that a disregarded entity and an S corporation are flow-through entities. Now, persons may say flow through or pass through, but they ultimately mean the same thing. And what that means is the net activities from the business flow through to you personally. Therefore, the business itself is not responsible for any income taxes. Right now, for the C corporation, it's not a flow through, as I mentioned before. It's independent of you. It pays its own taxes. Right? And then lastly, because these are flow-through entities and they're not responsible for their own income taxes, whatever the net activities are, your tax bracket is what would be used to assess whatever taxes will be owed, except for the fact that a disregarded entity here will be subjected to self-employment taxes, which is a makeup of your FICA taxes, which breaks down to Social Security and Medicare. Okay, now on the flip side, we have the C Corp, which sits by itself. It has a flat 21% tax rate. So you don't have to wonder how much your taxes would be if you were a C Corporation. You already know off the bat because it's a flat 21%. The last thing that I do want to touch on is the fact that the due dates are a little bit different, right? So if you're an LLC choosing to remain as a disregarded entity, no worries there, because the Schedule C has to be a part of your Form 1040. The due date is April 15th, so we're good there. But if you chose to go the S corporation route, your due date would be March 15th, a month before. So you want to register that and keep that in mind. And then lastly, the C Corp, the good thing here is it's April 15th, even though it's independent of your personal income tax return. So I really do hope that the breakdown of how an LLC can be taxed was really helpful to you and the different impacts that come with it.